Ogejo, and I work at the Institute of Economic Affairs under the Futures and Foresight program. Sorry. So today's webinar is about basically understanding the African Financial Markets Index and what it means for foreign investments. So just to give you an overview of what this index is about before we go to the nitty-gritties. So first, the index is intended to track the annual progress made by African countries, and it also provides guidelines on what areas need to be improved for countries that would want to build a strong financial infrastructure as far as foreign investment is concerned. So when you're speaking about financial infrastructure, what it basically means is so a financial infrastructure basically allows for circulation of money throughout a country's economy, and it also plays a very critical role in a country's economic development and stability. So just to help us understand where this conversation is going. So why this financial markets index is important is because over the years, we have seen countries across Africa trying to implement a number of national policies and frameworks that are based and focused on ensuring market developments for both local and foreign investors. So why is it focusing on local and foreign investors? It's focusing on local and foreign investors because one of the focuses or one of the key pointers to a strong African economy, or just an economy in general, is the ability of that country to attract foreign investments or foreign capital, and also how well the country, in as much as it's attracting foreign investments, how well does it develop its local investors? So in as much as we are focusing on foreign investments, it is also key that we also have a consideration on how well developed local investors are as well. So that is just to bring us to understand what today's conversation is about. And then in terms of my outline, we will look at what the index measures, and then we look at the methodology. And under the methodology, we will look at the pillars and the indicators therein. And as we will be proceeding, you will notice that the pillars, we have 6 pillars, and under the 6 pillars, we have indicators, and under the indicators, we also have sub-indicators. What will happen is we will not go into the details of all the indicators. We will explain the pillars, and then we will give explanations for a few of the indicators, 1 or 2, and then how it links to the indicators, just so that we understand what these pillars focus on. Because there are 6 pillars and over 40 indicators, and I don't think time would allow us to go into each of the 40 indicators. Then, of course, we look at what the scores and the ranking means for the jurisdictions that participated in the survey. And then, of course, my colleague, Leo, will come in and explain and give us the findings for East Africa and a focus on Kenya. What will happen under that is we have the overall funding for all the countries that participated in the survey for the 2020 index. And then he will now narrow it down to the East African countries and present a conclusion. After which we have a distinguished panel of experts from different sectors. We have from the investment sector, we have from the banking sector, and of course we have an economist in the house as well, who will then give comments on the presentation and also their views on what this index means and what areas African countries should focus on, and even the areas that foreign investors majorly focus on. Then they will come in, you will be allowed during the Q&A session to ask your questions, which they will gladly respond to. Before we proceed now to the main presentation, I'd like to make a kind reminder that we request that all our cameras will be off during the presentation. And as you join the meeting, please ensure that you are on mute. And as we proceed with the presentation and you feel you have a question that you need a response on, please make use of the chat box, ask your question there, and if possible, indicate who the question is referenced to, then is referred to, sorry, then we will ask the panel to respond to those questions. So please remember, cameras off, we are all on mute, and we are making use of the chat box. So straight to the presentation that we have. So what does the index measure? The index measures two things. One, it looks at the openness of a jurisdiction in terms of majorly in terms of availability of information, availability of data, availability of just general information as far as financial structures are concerned for that jurisdiction. And then it also looks at the attractiveness of a country. And when you're looking at attractiveness of a country, we are looking at, of course, legal frameworks that have been put in place that of course, not necessarily favor the foreign investors, but are worth them adjusting to investing to that particular country, so that should they feel there is an issue, they know there is a legal and regulatory environmentally friendly that they can then engage with that particular country. That's one. And then again, in terms of attractiveness, what products exist within that market? Because one of the things that we have to be very clear about is the index also looks at products and products that are available within the market that would then invite foreign investors into that country. So those are the two areas that are focused on the index. So openness and attractiveness. So in terms of who participates in the survey, we have, sorry about that. Am I back? Am I back? Can you hear me?
We can hear you, Winnie.
Can you hear me? Apologies for that. Winnie. So in terms of who participates in the survey, we have 60 top executives from different financial institutions that operate across it's no longer 17 countries. It is now, as at last year, it was 23 countries. 17 countries was when the first index came out. So when the first index came out, it was 17 countries. So we have the top executives are drawn from investors, from the investor sector, the banking sector. We have audits and accounting firms. We have regulators, securities exchange, and international developers. So basically that's an overview of who is involved. Then in terms of the methodology, for the scores and the ranking, the scores ranges from 1 to 100. So as we will proceed to be explaining, there are 6 pillars that are evaluated. And I had indicated earlier, under the 6 pillars, we have indicators and sub-indicators. So there's a way the scores from each of those indicators and sub-indicators are harmonized to get an aggregated or an overall score for a pillar. And it is very possible for a pillar to score 100, a maximum score of 100, depending on the scores it achieves in all these other indicators. So if for instance, under Pillar 1, a country scores an aggregate the overall score for that particular pillar will be 100. Then in terms of the ranking is determined by the score and how the countries performed in that particular pillar. So the rank, right? So I've already explained that the countries are first scored against a certain indicator. The scores from those particular indicators in that particular pillar are then aggregated for that. So just moving on to the pillars that we were talking about. So we have 6 pillars. So under pillar 1, which is the market depth, the survey examines the size. Apologies for that. Apologies for that once again. So as I was explaining, under the market depth, the pillar examines liquidity and depth of markets and diversity of products in each market. So just so that you understand what that pillar does, we'll go as we proceed to the details of the indicators and the sub indicators. So under pillar 2, there is the access of foreign exchange. So what happens with access to foreign exchange is the survey assesses the ease with which foreign investors can deploy and repatriate capital into the region. Then when you look at pillar 4, which is market transparency, tax and regulatory environment, market transparency, tax and regulatory environment, it evaluates the tax and regulatory frameworks within a jurisdiction or within a country, as well as the level of financial stability and transparency of financial information. So again, if you look at that element of attractiveness, and it has an element of openness. When you're looking at regulatory frameworks within a jurisdiction, you're looking at issues of attractiveness. And when you're looking at transparency with financial information, we are definitely looking at openness within a country. Then under pillar 4, we look at capacity of local investors. So under capacity of local investors, that pillar examines the size of local investors. It also assesses the level of local demand against supply of assets available in each market. Again, if you look at that, you look at the attractiveness. It looks at the attractiveness of that particular country. Opportunities. Under macroeconomic opportunities, that particular pillar assesses a country's economic prospects, and it uses different indicators, I'll call it that. So it looks at the metrics on growth, it looks at debts, it looks at export competitiveness, it looks at the banking sector risks. So basically what risks exist within that country's banking sector, and of course, availability of macro data. So again, if you look at that, availability of macro data speaks to openness, and then all these other details within that particular macroeconomic pillar look at the attractiveness of that particular country. So when you look at the legality and enforceability of standard financial markets, which is in short we are calling the SFMMA, this particular pillar tracks the commitment to international financial markets, financial master agreement, and how well the netting and collateral positions are being enforced, and how strong the solvency frameworks are within that particular country. So having a look at that particular pillar, you notice that, yes, it's majorly looking at the attractiveness of of that particular market or that particular country. So with that explanation of what these pillars entails, we will try to look at a few of the indicators within these markets. So, sorry. So when you're looking at market depth, under market depth, we have 5 indicators and several sub-indicators. So under each indicator, it has sub-indicators that they look at. So when we're looking at the size of the market, so size of the market speaks to the size of the market is actually just made up of the total number of potential buyers of a product or a service within a given market against the revenue that the sales may generate. So if you look at the total, the total number of buyers, potential buyers of a product, and then you look at it against the revenue that can be generated, it can actually give you a picture of the size of that market. And under the size of the market, they look at the total sovereign and corporate bonds and then market capitalization. And when you're looking at market capitalization, for example, we're just looking at the size of the stock market. And just to give another very quick example about under the depth of the market. So when you're looking at the depth of the market, we're looking at the ability of a market to absorb large market orders with a significant impact on the price of the security. So when the market is, we consider the market depth good, or for lack of a better term, the market depth is considered market friendly when it actually has the capacity to absorb large market depth, large market orders. And that ability to absorb large market orders it's not just about absorbing that large market order, but it's also about delivering it. So if you absorb that market order, then you have to be in a position to deliver on it, right? So like I explained, we will not look at all these indicators, but we are working on a policy brief that will definitely explain each of them. So once it's ready, of course, we will post it on our website and we'll alert all the attendees to have a look at it. So when you look at the second pillar, which is the access to foreign exchange. So access to foreign exchange has 4 indicators that it looks at. So for instance, if we look at net portfolios and ratio to reserves, so net portfolio is described as a statistic that tracks how much money is being invested in a country by foreign investors, and also shows the extent to which domestic companies are selling their foreign holdings. So under that, we are looking at the total net portfolio flows. Of course, I've explained what that is, and the ratio to foreign exchange reserves. That helps to look at, allows a foreigner to look at the stability within that foreign market. And then when you look at capital, when you look at, sorry about that. Okay, so when you look at the capital restrictions, so under capital restrictions, what capital restrictions do? Capital restrictions are the measures that governments or central banks take to control the flow of foreign money in and out of the country's economy. And this majorly applies to countries with a weak or developing economy. So these controls, what they largely do is they put let's just use the word control again. They put control on how much local currency can be exchanged or expatriated from that country. So for, of course, as Leo will be coming in, he'll give examples of countries that are actually doing this. And I think one of the countries that are currently exercising capital restrictions is Ethiopia. Then looking at our third pillar, which is the market transparency and regulatory framework. So under this, we're looking at financial stability regulations. What financial stability regulations, what it basically means is a poorly regulated financial institutions has the potential to undermine the financial systems. So if as long as you're not having good regulations for your financial systems, of course, that system is bound to fail. And why these financial regulations are put in place is to ensure the soundness of the financial systems and also protect the consumers. How this is evaluated is they use the Basel Accords implementation stages. So they're trying to see where a country is at as far as the implementation of the Basel Accords is concerned. What the Basel Accords implementation does, it's first, it is an area it has three sequential banking agreements. And these three sequential banking agreements are set by an organization or a committee called the Bank Supervision, which the Basel Committee on Bank Supervision. And what this committee does, it provides recommendations on banking and financial regulations. And it is very specific on what areas it looks at. So we have the capital risk, it has market risk, it has operational risks. So the survey just basically evaluates what the stage at which a jurisdiction is when it comes to the implementation of this of the Basel Code. So just to give you an understanding on what this Basel Code is. So we'll proceed to look at our pillar number 4. And the pillar number 4 just looks at local investor asset concentration. And under local investor asset concentration, we are looking at the willingness of local investors to invest in their domestic market, because it makes no sense and for a foreign investor to come and invest in a country where its local investors who have potential to invest within that country are actually running away from it. That a local investor is running away from that particular country clearly points out to a problem. So that local investors can also invest within their countries speaks out and signals a lot of confidence in that market. So under local investor asset concentration, we look at the value of pension assets per capita, and then we look at pension fund assets ratio to local markets, capitalization of equities and bonds listed on the exchange. So when we move to the pillar number 5, pillar number 5 has 8 indicators. And if you look at all these indicators speak to the size and performance of an economy. And a lot of them determine the extent to which a financial market is developed. So when you look at all like GDP, living standards, of course, the higher the living standards, the better the economy. If you look at all those things, if you look at budget releases, it actually speaks confidence. Of course, for budget releases, it's more of a confidence issue and openness issue, and it also speaks to certainty. It presents, somebody can decide whether that market is certain, the certainties within that market or the uncertainties within that market can actually come out when one looks through the budget for that particular country. Then our final indicator is the legality and enforceability of the SFMA. And like we said, this speaks to two things, of course. It speaks to the attractiveness of a country, and it also speaks to the openness of that particular country. And if we look at the insolvency framework, so insolvency frameworks are rules that are considered to determine how to resolve distressed assets. And the distressed assets can come about for different reasons. We can have a high default rate or any other unforeseen or of course, unforeseen market conditions that are not very favorable can also lead to having to work with the insolvency framework. So why this is important is it allows for business activities to continue, or assets allows for the redeployment of assets to a more productive use. So basically, we just wanted you to understand what these pillars entail and what under the survey is looked at for each of the pillars. And once we have tried to bring this, to paint this clear picture, so when we move to the findings, you are now in a position to understand, as Leo will be giving examples of how countries are performing in these particular pillars, you can actually relate that performance to some of these indicators and sub-indicators. And again, we apologize that we could not go into all these pillars, all these indicators and sub-indicators because as a matter of time, but we, like I said, we will be doing a policy brief that will go into the details and give specific country examples for how countries are performing in these particular indicators and sub-indicators. So having said that, I hope we have a very rough but clear picture of what our conversation is about today. So I'll allow my colleague Leo to now come in and explain to us our findings for East African countries and with specifics to Kenya, and also to specifics with countries that are doing very well in that particular pillar and why that is so. So thank you so much, and karibu sana Leo.
Yes. Good morning, everyone. My name, as Winnie has mentioned, my name is Leo Kemboy from the Institute of Economic Affairs. I'll be explaining the findings on the of this index, and just to give example for Africa and EAC to explain so I'll be explaining about sorry for that. I'll be explaining on the performance of Africa and the EAC. On the right chart, as you can see, the country with the highest score is South Africa with 92, followed by Mauritius with 79, and now the rest of the pack, the other 7, come below that. So there is a very big reason, as Winnie has explained, why these results are like this. The first one being the depth of access to foreign exchange, the depth of foreign investments, and also the size of the economies. And South Africa leads in that. If you look at South Africa's equity market and the bond market, For the equity market capitalization as a share of GDP is over 200%. So that shows how deep the depth of that market, the extent of the depth of that market, how big it is. Mauritius is a very unique one because just like South Africa, apart from if you look at the higher incomes, apart from income, its incomes relative to population, the per capita, the incomes per capita being high, Mauritius has prided itself as the financial capital of Africa. And if you look, for example, some of the things that they offer on tax, that they have no withholding tax, for example, on dividends, allowing firms in Africa to book their profits in that side of the market. So it's the Mauritius one, apart from the income per capita, is also how they've set up their financial market. So the rest of the countries include Nigeria, Botswana, and Namibia. Kenya is 7th overall in Africa, and then Morocco, Zambia, and lastly Uganda. So and each of them has its own specific strengths. Like, for example, Namibia, the size of overall in this index, it leads in the size of most of their pension capital from the local investment comes from their pension pool, which has helped to boost its confidence, the confidence of investment in its own in their own market. Nigeria is one of the biggest economies in Africa, and that explains the extent. Largely, what we see from this index, apart from those countries that have put in specific measures to harness that to harness the extent and the depth of the financial market. Most of them are relatively determined by the size of the economy. Yeah. So on the other side, you look at the East Africa. On the right side, the East Africa chart, which explains the overall performance. So as we all know, Kenya leads in this, largely because of the extent of the economy, and also our financial markets are relatively well developed compared to the EAC counterparts. If you're even looking just at even though our NSE is continually diminishing, but although Kenya's NSE is continually diminishing, but the performance in the bond market and has continued to grow over time. So followed by Uganda, Tanzania, and Rwanda. And to be more precise, that the overall performance is not largely is largely explained by the market itself, but there are other factors that Winnie had explained, like, for example, the capacity of local investors, access of foreign exchange, the macroeconomic opportunity, and those ones will reflect, as I explained, for each of the specific indicators. So, looking at market depth, Kenya leads in this category with a score of 52. Overall, for the index, the score would be suboptimal, but within the EAC market, the score would be higher. So on the market depth, the major issue is, the major thing that is measured is the size of the bond market, the size of the bond market, and the size of the equity market, which if you compare relatively to what Uganda, Tanzania, and Rwanda have, is larger, is one of the biggest. For example, on the bond market, we'd expect Kenya leads, and even generally based on the diversity of the products that is offered in the equity market, like the rates, the derivatives. Sorry, someone is on. Okay, sorry. So and based on that, the extent of the market depth is largely explained by those two factors. So and for the bond market, for government bond market, I think aside from the issue of the economy and aside and the size of the number of products that are available, like the rates, the derivatives in the repo market, and all those, it's, I think, Kenya's fiscal policy has largely determined the size and the extent of the bond market, which has overall opened up more, made the size of the debt market to be bigger. And yeah. Now, on the access to foreign exchange, among the EAC countries, Kenya ranks for the EAC 4, which is Uganda, Rwanda, Tanzania, and Kenya. Kenya ranks the fourth, and it measures, this one measures capital controls, as Winnie had explained, and largely the rigidity of the exchange rate regimes. So for me, and this is something that the IEA has emphasized in the past, that we are not, this one would not be a surprise why Kenya ranks fourth on this, because the rigidity, if you look at the exchange rate regime, the rigidity is, most people, we contend that this is not it's not a free floating. There's literature around this from the paper that was done by the IMF. There are other reviews that have been done by various experts, including by various experts, and one thing is that Kenya's exchange rate regime is not flexible. It's managed and not certain to all market conditions. So another thing that is measured for the access to foreign exchange is capital, those restrictions on exporters, and largely within the EAC, the performance, the other countries have allowed those transactions, the administrative transactions, to be done directly by banks themselves, which is a good thing across the EAC, and not just the central bank alone. But largely, the position of Kenya here is determined by the way the exchange rate regime is being managed. I also want to say that for EAC, the capital controls are not, there have been improvements, investments that have been done to make it more, the capital control, to make it more flexible for investors, and this one has been very fast. So pillar 3, market transparency. So market transparency. So on the market transparency, Uganda ranks first in the index. Kenya ranks third, and its market transparency, tax, and regulatory environment. So there are three things that are measured here, which is one of them being corporate bond ratings. The second one is tax, and the third one is just market transparency, how firms makes disclosures to investors. So one of the things that we know from Kenya is that, for example, the reason why Kenya improved, as you can see, from 2019 to 2020, the score went up higher. So one of the reforms that was done is the regulation that was done by Capital Markets Authority, allowing companies to do a buyback option, and for this, so that one improved the market transparency. Secondly, the issue of disclosure that is done by investors. If you look for whole listed companies, the disclosure set for example, for this year, for last year, all firms were able to disclose on time, and this one creates that market integrity, people to be able to make investment decisions on their own, notwithstanding the fact that the size of the market, that of firms that have been listed for is shrinking. Another issue that is measured here on corporate bond ratings. So for the case of Kenya, it receives corporate bond ratings and all the EAC countries from Fitch, Moody, and also SP. And regionally, it is ranked by the Johannesburg-based GCR, which provides ratings for firms, for just sovereign, and also firms, the firm ratings for investors to be able to make decisions. But the score, Kenya's score in this is largely explained why it ranks third in the EAC despite ranking first on the market depth. Is largely explained by market transparency and the market transparency, and also the tax environment. Although for the whole of EAC, I need to place a caveat here. For the whole what they measure specifically for this is withholding tax on interest rates, and also withholding tax on dividends. So if most of these countries, the EAC, because of the agreement on tax, most of them have almost the same rate, 15% for withholding tax on dividends, and also for, if you looking at what was disclosed in the report. But generally, it's explained by market transparency, how firms, what firms disclose. But Kenya has made significant improvements, as you can see from 2017 to now. The adoption of the International Financial Reporting Standards, the IFRS, which was able to weed out firms that were not reporting their correct financial position. But a lot can still be made, because given what is being done across in Uganda and Rwanda, Kenya there's room for improvement. But as we go, I need to say that things have changed from in the last 5 years, that the regulation around the financial markets has continued to evolve, and more faster than before. So on Pillar 4, the capacity of local investors, as Winnie explained, that what is measured here is the level, the ratio of pension funds to what is invested from the pension pool as a share of to population. And given the extent of Kenya's market, the size of the market, the depth of the financial market, and also the size of the economy, we lead by default. But if you look at the score, it's 41. which is not yet even 50%. It's not 50. It's not 50 compared to other markets like South Africa. Namibia specifically leads in this in the overall ranking in Africa for this for this pillar. And what this ranking tells what it tells, the picture that it gives is that the looking at economic fundamentals and looking at that confidence, it signals confidence because by local investors being able to invest in that market, it shows the certainty, and also the certainty, and also what this does is that it gives firms longer investment horizon. So because most of the pension funds, it's long term. Those the funds are required on a long term basis, and it gives firms that ability to plan because of the longer investment horizon. However, as you can see, Kenya is ranked 41, and largely most of these can be explained by the macroeconomic opportunity that ever since in the last 9 years, the government's government's position in the economy has grown up, and but at the same time that this pension in Kenya is still a big issue, because unless reforms are done to make it a contributory scheme, because what is provided now, the superannuation scheme can change the picture of this. But as the private sector firms, because there are fewer people in the economy who work in the formal sector, who can even contribute directly either to provident fund or to any government pension scheme. So that's why the size of the market is the capacity is this low. But when reforms are done and the structure, if Kenya gets, for example, to structural transformation where there's more labor productivity, there's more labor participation in the labor market, participation goes up, and where now this can provide those, can improve on, can be able to get more pension. On macroeconomic opportunity, so Kenya ranks second after Uganda, and then Rwanda and Tanzania. Here measures the seven indicators that Winnie is mentioned. The bank largely can be categorized into three, which is the competitiveness of exports, the GDP, the growth of the economy, which is the GDP growth, and the income per capita. And the third one is the banking health. So looking at the ratio of non-performing loans to the ratio of non-performing loans yes, looking at those non-performing loans. One of the things that you notice in 2018, Kenya was leading in this pillar. What could have changed, and this is my explanation, is that the elevation, Kenya's, and also the external debt to GDP. One of the things that is measured here is external debt to GDP. Kenya's in 2018, that's when Kenya's level of debt distress changed from low to moderate, and then in 2020 now has changed to high. And one of the things is that's why the performance could have stagnated, and also that generally the growth, the last time we had an higher GDP growth was in 2018, which was 6.6, the 6.3. Also looking at the 2-year forecast, after that, we know last year Kenya's economy contracted based on the data that from IMF. We also know that which also could lead, which also because of that the output gap reduced the incomes. What is the incomes available per capita? Yeah. So that explains largely the performance in this category. Looking at Kenya's financial market, the non-performing loans relative to EAC, and Kenya's financial markets are well developed, and but still Uganda provides the edge, and this could. One of the things that is also measured is, for example, regular budget release. And in terms of budget transparency, for example, Uganda is ahead of us, and because for them they don't just provide data, but also provide data in long format, provide data in Excel downloads. So the level of that level of budget transparency has gone high. In Kenya, we still go around a few things. For them, Uganda and South Africa are debating more concrete, for example, they're no longer evaluating the budget on it has risen. Another thing that is evaluated here is the availability of macroeconomic data. So Kenya has been consistent on macroeconomic data. They publish annually. There's the ones that are published quarterly. For example, there are those that are published weekly. Like, for example, the ones that Central Bank publishes weekly and monthly and quarterly and also annually. On the extent of financial market, there's the quarterly economic budget review by National Treasury published, and then there's what is published by KNBS as the overall agency tasked by law to collect and publish data. But now, for example, like this year, in an unprecedented move, I think for the last close to 20 years, the KNBS data has been led. So this one, next year, if you look at this pillar, you will see the ranking because of that delay in data, because it creates uncertainty. That is not just looking as an economist looking at Kenyan data. I don't think there is nothing that amiss, but by just the ability to not publish that data in time would create unnecessary certainty. And the way financial markets, the investment decisions that are needed to be done in the financial markets has to go consistently with real-time data. So, and these are things that Kenya can improve on. So that's from Pillar 5. On Pillar 6, the legality and enforceability of the standard financial markets master agreements. So, as Winnie had explained, there are three major ones. So here you're looking at the insolvency laws. You are looking at what we call the GMR, the Global Master Repos Agreements, and then you're looking at the and then so part of Kenya leads in this largely because we have strengthened the insolvency laws relative to the EAC. Also looking at something they call the global master repos agreements. These ones are being done directly at the bank level. Another one is that there is what we call netting out rules, the legislation, which Kenya is in the process of drafting one, And this one, the netting out rules helps to reduce the risk products in the secondary financial markets, financial, such as especially in the repo market. When you have a primary dealer, what's supposed to happen when risks happen? And those, if you look generally in terms of this, when Kenya is able to do the netting legislation, this score would improve greatly. So yeah. Now coming to conclusions. One thing that you've seen evidently, that the openness of economy and now the growth, the size, the growth of the economy, which is, for us, we've deliberately measured it in income per capita, determines the depth and the breadth of the financial markets. And largely you can see from because if you look, for example, at Mauritius, it has in PPP terms, it has the income per capita of over $10,000 in purchasing power parity terms. This is not in the current terms. So that one, which is a good thing. Now another thing is that the difference in performance between South Africa, Mauritius, and the rest of economies show the level of progress that still needs to be made in the financial markets, because the extent and the depth of the financial markets, if you look at that, the overall chart this overall chart on the left hand, you can see South Africa and Mauritius at the top, and then the rest of the pack is below them. So the progress in getting those reforms right and being able to do shows that there is a lot that needs to be made. So while Kenya leads in the overall score in the EAC, it lags behind in the access to foreign exchange pillar. We emphasize this more because largely, aside from just opening up the economy, also the financial market, the access to foreign exchange the reform around the access to foreign exchange has to be more certain. It has to be competitive, and the benchmark here is to benchmark with the economies in the emerging and developing markets and the developed economies, because that only can allow foreign investors to put in their money, because foreign investors don't put money where that certainty is not proven, especially on access to foreign exchange. The third one is the tax certainty of overregulation in other sectors, which is the overregulation is just a common economy problem. It's not related directly to financial markets, but other sectors, as example, the progress in improving the market transparency, tax, and regulatory environment. And then the fourth one is also a general economy problem, which is the structural issues, which is public debt, the balance of payments, relating to fiscal policy is affecting Kenya's macroeconomic opportunity. So, and just to expound on that, is these structural issues brought in by public debt that now you have to run faster to be able to, because part of what is, because one of the things that Kenya has that Kenya is in now, and it is the issue that we are in an IMF program, and this IMF program, we have an IMF program not because of anything else, but because just we have a structural issue with our with our fiscal policy, and this one has a lot to do with how the political economic problem on how our exchange rate regime is being managed. This also structural issue relates directly to how our tax code changes on an annual basis. It also relates to how government is trying to do administrative actions here and there that have second order effects that cannot be. So it's largely the extent of development of financial markets relates largely to the extent of the size of the economy. So, and this structural issue has to be solved over time. So thank you so much. And I now hand back to John Mutua so that he can take from there. So that is the link, and thank you so much.
Yeah, thanks a lot, Kemboi, for taking us through those findings of Africa Financial Market Index, and of course for Winnie, who basically set the scene. My name is John Mutua. I work as a programs coordinator here at the Institute of Economic Affairs, and I'll try and help in terms of moderating this session. My takeaway from this is that Kenya is the most mature, or Kenya has the most mature financial market in East Africa. And this is obviously driven by the fact that it is leading in the pillar on market depth, given the size of bonds. I mean, just the activity around bonds and equity market. It's also leading in within East Africa in capital capacity of local investors in that pillar, as well as the pillar on the last pillar on legality and enforceability of standards, financial markets master agreements. However, the reason why Kenya's position and rank is, I mean, the reason why we have a gap between Kenya and the leading countries in Africa, that's basically South Africa, Mauritius, the likes of Nigeria, is obviously the fact that we are not doing very well with regard to the aspect of, or the pillar on access to foreign exchange, as well as the pillar related to issues of market transparency, tax and regulatory environment. So that basically explains that, and of course the specifics have been shared by Kemboi. So basically, on the whole, you can see the importance of this index in the sense that it shows the different stages of maturity of financial markets, and you can see the specifics in terms of areas where, for instance, Kenya needs to improve in terms of, or making the necessary improvements and reforms in order to improve our financial infrastructure. Now, so I would like, without further ado, basically to invite we have 3 experts who will basically share their views and opinions. I know they interact quite a bit with this, or they've interacted in the past, and of course, even for this recent index. So the first presenter is Elizabeth Nkuku, who is the Chief Investment Officer from Saiton. And then thereafter, she will be followed by Raphael Agung, who is the Chief Economist, NCBA, and of course, Kwame will conclude. So they each have about 7 minutes just to share their views, and at the same time, maybe speaking to the aspect of what COVID, whether COVID has had any impact on the current index or the results that have been shared, as well as what the impact of COVID will be in the next year's assessment. And then, of course, they can also speak generally in terms of where they think we should improve as a country in practice, basically, on in terms of attracting foreign investment, as well as any other important issues that they may want to share with us. Elizabeth, I guess we are ready. I can see you, so please go ahead.
Okay. So thank you. So thank you. I think it is really good to be discussing this particular index, and it is definitely a significant step in the right direction, especially for people who want to see the market grow. We are actually seeing a lot of people pulling all together to see the better African market, and it's definitely good that ABSA partnered and got this out. In terms of the key questions then is, if you're an investor, what do you look out for? And does this index really speak to what you would want to see? So from my perspective, I would look at three key things that any investor, either whether foreign or even local, look out for as they are determining where they want to invest. So the first one is, as you put in money, you want to get the maximum sort of return that you can on a risk-adjusted basis. So the African market definitely has a lot of potential, but the question is, if I put in my money, will I be able to get it out, and what kind of returns am I going to get? So looking at the market depth, that tries to explain that if, for example, I want to invest in the Nairobi Securities Exchange and I want to make sure that I get the maximum value, I look at the companies that are able to deliver that value, but at the same time, do I have sufficient stocks to buy for me to be able to get that? So market depth helps determine that. And looking at the risk levels, as you get, nothing in life is really certain. So even as I project and say that I'm going to get the best return, so the question is, what if things go wrong? What is my fallback position? So the enforceability of contracts then comes in, and that again lies together with one of the things that I looked at in terms of the state of the institutions. As long as the institutions are strong, then it means that most foreign investors or any investor would actually be more comfortable working in or putting their money in there. So the other thing is the ease of getting your money out. You can get all the best returns. Maybe you're doubling or tripling your money, but for as long as you're not able to repatriate your money out, or you're not able to get your money out, then it becomes a significant challenge. So the index tries to bring that into the fore. And I think one of the things that we have seen as a country, Kenya, in as much as our foreign exchange is completely floating, I think there are just those restrictions that comes with it, and that's why maybe we are ranking slightly lower. So it is very important for every investor. As they come in, they should be able to be sure that they're putting in their money and they will be able to get it out at the right time. Then the other thing is the state of the institutions. So the governance of any country really determines how well the capital markets are developed. So for as long as maybe the judiciary is working well, you have institutions like the various regulators, the tax authorities. As long as those are well shaped and it's clear what needs to be done where, then it means that you can continuously be able to get capital coming in, either foreign or local, or from the local investors. So from my general perspective, for any investor, those are the key three things that they look out for: making sure that you're getting the best return on a risk-adjusted basis, making sure that you can easily get your money out, and the status of the institutions. Because if the institutions have an issue, then you will definitely also have an issue in terms of repatriating your money back, and also certainty of being able to know what is it that you're getting into. So looking at the report, some things that stood out in terms of the regional performance of the African continent, I think the Southern African countries seems to be doing better. The Western Africa, with especially Ghana, really stood out. And even if you're to look at the performance on a year-to-date basis of the stock market of Ghana, it is actually very clear that something good is happening in Ghana. So it will just be good to dig deep and understand what exactly that is. In the East African region, I would put ourselves at number 3, and meaning that we still need to maybe work on, and in line with everything that happened last year, most of the countries, actually most of the regions, saw a decline in terms of growth of the index. But in the East African region, now looking at the specific countries, something that stood out for me is the fact that everybody declined. That is Kenya, Tanzania, and Rwanda, but Uganda stood. It was just flat. The performance of Uganda was flat, meaning that we need there is a lot of things that maybe reforms that are happening in Uganda, and maybe we need to be cognizant of the fact that maybe they will get more investors, maybe compared to a country like Kenya. So Uganda seems to be moving in the right direction. There are a couple of positive things maybe coming out from there: the primary dealership, the foreign currency ability to repatriate your cash. So that is definitely a good thing. So Kenya still remains a market leader, and given also that most of the institutions that we have in Uganda are actually cross-listed maybe from Kenya, so it remains a market leader. But it's really good for us to know that Uganda is doing a good thing, and most probably they are getting some things right. And if other than even away from the market, I think just listening to maybe the fact that we get some food from Uganda. So I think there's really definitely something good coming out from there. So Kenya remains a market leader, but we need to maybe change some of the things that are lagging us behind, like the ability to repatriate your cash or the foreign exchange controls, because that could lag us behind. So then the question then becomes, if you are a person in leadership and in financial markets, what then should you be looking out for us to see a significant improvement, especially now this, and I'm just looking at the Kenyan East African context. I think some of the challenges that we face include the financial literacy levels remains low. So the index looks or limits the capacity of local investors by looking at the pension schemes alone. But the question is, are there other pools of capital that can also be looked out for, and how would that look like? So if you look at the Kenyan context, the SACCO movement is equally has equally a lot of capital, but the question is, do they participate in the financial market? So the question would be, how then do we bring that pool of capital to participate in the capital market? For things like the unit trust and mutual funds, we still remain a very small portion. I think we are at about 100 billion compared to the pension schemes that are about 1.3 billion. So how do we grow that so that we can actually grow our local participation? So one of the things I see is ability to let people understand that they can take advantage of these available pools, available instruments for them to actually pull their funds. So financial literacy goes a long way in terms of helping markets grow. Then encouraging the growth of even much stronger institutions. And what we have seen, and especially the Capital Markets Authority, is coming up with a couple of reforms so that they can be able to attract more capital. So that should continue. And even when you think about our tax regime, we need maybe to think about what do we do to increase more people, actually give more incentives so that people can be willing to come and do business here. Then from a physical perspective, because one of the other challenges that I think that most African countries have is the debt levels that are increasing. So the question is, how do we become more physically, how do we improve our physical discipline, and how else can we be able to fund our budgets so that we are not significantly exposed from a debt perspective level? And this again goes back to the developing of the institutions, because one of the ways to grow the capital market is to have more companies come into the market to list. So how do we encourage that? And given that some of the big institutions that we have, they're largely driven by government, the most parastatals, we should actually be looking at how do we make these parastatals more efficient so that we are able to list them, because they are huge and they will be able to get more capital coming in. So in terms of how I see this panning out going forward post-COVID, or during this period of COVID, it's already we have seen significant growth in the capital markets. So if you think about the Nairobi Securities Exchange, it's up about 22%. The Ghanaian stock market is up above over 30%. The Ugandan stock market is up about, I think, similar 20%. So I would expect that the 2021 index is going to be definitely better than we saw last year, just because people have learned to live with the challenges that are currently there. So the biggest question is, how are the governments and institutions adapting to the new norm? And in terms of the countries that will even do better, most probably it will be the commodity driven, the countries whose economy is likely driven by commodities, because I think we are seeing a pickup in that. So all in all, my view is that this year will be a better year, but there is still a lot of work that needs to be done in terms of encouraging more institutions coming in, because the foreign investors, for us to get sufficient foreign capital coming in, we have to have depth. We have to have places where they can invest. So that is one of the things that we need to focus on and make sure that the macroeconomic environment is conducive for good performance and create a way in which they can repatriate their capital back when need be. Thank you.
Yeah, thanks a lot, Elizabeth, for those insights. I think we'll just go straight ahead to, I would like to invite Raphael. Raphael Lagung, same questions to you. So please go ahead and share.
Sorry, thanks, John. I hope you can hear me. Thanks, John.
Yeah, we can hear you.
Yes, I'm not sure I remember the question, but I'll make my comments anyway. I appreciate our 7 minutes. Appreciate our 7 minutes, and as I grow older, I've ended up being a little wordier than I would have liked. So I hope I can fit my comments within the 7 minutes. First, thanks for putting together the webinar. I think it's opposite for the reason that I guess not only because I'm a practitioner in financial markets, but I think financial markets are consequential to a lot of the things that are important to us on the macro front. The first point I'd like to make is, and I'm sure the IEA is well apprised of this, is if you've been studying African economics for say 2-3 decades back, or perhaps longer, the challenge we've had has been around what I call the data or statistical framework, making it very difficult sometimes to understand direction of our economies. There's over-reliance on official data or releases, some of which, as you pointed out, I guess in the KNBS case, are often late or not comprehensive enough, or not even specific to some of the variables that people are looking at. So I've seen an interesting development in the recent past where I guess pushing thought leadership mandates broadly, private sector players are beginning to get into the data production or statistical releases side of things. So we've seen, of course, ABSA in partnership with FMI coming up with this index. We have Standard Bank. Sorry, we have Standard Bank giving us the PMI. Elected that as their thought leadership sort of product. And then I think we're seeing a lot of others coming through. Citibank has the GPS, slightly different sort of data release. It's sort of analytical work on different asset class developments that I think are very useful. So what I'm saying is, first point is I think I want to upload ABSA for coming up with this. I think it's the 4th year in a row that they've been able to publish it, making it a lot more better for us to understand African economies more in depth. So that's a great thing. The second point to make is, of course, and I think in my opening remarks already sort of intimated the same, the finance growth nexus cannot be gainsaid. I think literature is completely rich on that. So away from just the measure of openness and attractiveness that the index specifically addresses, understanding financial market developments in and of itself as a proxy or as a way of determining Africa's growth prospects would be useful. And to that extent, I think that's another contribution on the macro front, which is useful, depending on what you take of the view. Now, on to the presentation itself. So Leo gave us a summary of the findings. That was very useful. It's pretty, I think it's 40 pages, the last issue on 2020. So it's pretty standard. If you go back to the inaugural issue, again, you can track the performance that it took us through. And I think for the most part, there are no surprises. So there was no aberration whatsoever, even with COVID in 2020, which is, I guess, the report in question today. There is something that I think should have been useful to make. And sometimes people argue it's a distinction without a difference, but I think in this case, because this index is going to lead us to some sort of conclusions, it's important to do so. And this is the age-old question on the difference between foreign direct investment and foreign investment holistically, or foreign portfolio flows. I would argue in a very fundamental sense that perhaps it's a distinction without a difference. Sometimes I argue that, but for this specific reason, I think that important difference should be made for the reason that if you listen to, I think it's Liz Nkuku, sorry to use that name, yeah, the comments made, and I guess perhaps even the report itself, it's obvious that the lens is purely a foreign portfolio flow sort of assessment. So, and I guess I can accuse ABSA because of their identity for having that lens, because that's what we do as financial market practitioners. And that's not necessarily always the what's crucial in terms of attractiveness of foreign investment holistically. I hope I can make that clear. So ease of can I buy some equity stake in Kenyan stock markets or South African stock, and how fast can I get it out, including the return question that I think Ms. Nkuku spoke about. Those are very important from an investor point of view. And to the extent that you're attracting investment, yes, holistically your macros will benefit from that. But it's not necessarily the same thing as if I have an FDI stake in a particular entity, which is what I'd find more useful for policy makers or people driving these economies. So take, for instance, the Ethiopian Paradox. All right, the report is justifiably rating Ethiopia very, very badly. I think it's last on almost every pillar. And that's true if you know what's happening in Ethiopia. And of course, that is even true in spite of the fact that report is, as Leo pointed out, is in some ways a collation or a score of how big you are. It's a size question. I think Leo made that point very, very succinctly. So in spite of Ethiopia's size, I think I would argue macroeconomic prospects as well. In terms of that, the index, it scores very badly, understandably in my view. Yet, if I was looking for an FDI type of analytical lens, I'm not seeing anywhere, and this is true, for instance, if you look at the UNCTAD reports right now, leading FDI destinations in Africa remain South Africa, of course, Nigeria because of what's happening there on the fintech space, Kenya, Morocco, and Ethiopia is featuring there very visibly. So that is despite what the index would lead us to presume. And that distinction, therefore, for instance, between FDI and foreign investment holistically, with specific lenses on just foreign portfolio flows, which is all I think the report is speaking to, needs to be made. I think that's the important analytical rebuttal that maybe I had. And then I'll come to something that I think is also very useful for practitioners, and I'll make one last comment on with regard to Kenya and perhaps take quibble with some of the report's finding, but also Leo's interpretation of the same. So anecdotally, I don't know how many on the call, and in the study of us who recall 2-3 years ago with the why the insolvency framework is pretty, I think it's a very important pillar. 3-4 years ago, I think you saw the collapse of Chase Bank. And what ended up happening is that the repo market, the repurchase agreement market in the Kenyan space had a holistic reliance on lien framework. So you take a lien on collateral, and then supposedly you have some comfort from a collateralization point of view. What happened though is with the collapse of Chase and the onset or commencement of the KDIC Act, because that's what becomes the operational sort of law within insolvency within the banking sector, people end up finding themselves exposed. So you lien meant nothing because there was no actual title transfer of the underlying collateral that people were holding. A lot of people forget that Chase Bank actually went under at a time when it was very liquid in the interbank market. So I know because I was a practitioner at the time. Chase Bank was heavily liquid and was lending money back and forth to so many banks. So it wasn't at the first instance a solvency question. Well, it was a solvency question, but from liquidity-wise, they were pretty sound. And yet, what happened at the time was with the advent of the KDIC Act, which is now the law that comes into play, the solvency framework ended up being completely weak. And there's a couple of ramifications from an interbank repo market point of view that we saw happening. So it's important then that that pillar, at least, even with my earlier critique noted, that pillar I think is very useful in terms of just discerning development of financial markets broadly. I then come finally, I think I'm already gone beyond my 7 minutes. So let me conclude with the question on the actual findings. And this is where I take issue with both the report, the results. And I think that, in fairness, I looked at the methodology very critically. I want to believe that the quantitative analysis aspect of it, the integrity there, I'm not going to question that. But I do note that the authors of the report also make explicit that there are qualitative judgments that were made across the pillars. I think a list of market practitioners, including investment CEOs, XYZ, that they do. And I think there may be an overdue influence of that sort of qualitative aspect of the report that is affecting some of the findings. Of course, Leo's interpretation of the same was largely in agreement. So this is on the access to foreign exchange, and I'm talking specifically to the question in the EAC, the EAC4 that have been rated. Kenya rates at 57.1, last bottom was close, and Leo believe at this point. So the report, the index would have me believe that from an access to foreign exchange standpoint, Uganda, Rwanda, and Tanzania is scoring far much better than Kenya. I'd argue no. I mean foreign exchange markets, that's patently false. And why is it false? Because I think if you look at the quantitative aspects of the index, there is a component of it that they measure vis-a-vis results. So without a doubt, Kenya has the highest results of all three across the time that the report was done. What I think may explain Kenya's bad performance, and Leo alluded to it, is the question on whether we have a free-floating currency. And that's a qualitative judgment that I think, and it's a sensitive point, I know, I work for a bank, so I'm conscious of that. So the central bank management of the foreign currency regime and the arguments on the freedom or lack thereof of that float has been reigning for a while. It's been led primarily by the IMF, who have argued that, of course, the currency is overvalued. It's only gotten worse with COVID and in the recent past, our debt questions. I think Leo was pretty eloquent. I agree with all that. But even if you take the sum total of that, I know for a fact, for instance, that in Tanzania, as I speak today, there's been an existing parallel foreign exchange market to this point throughout the preliminary report. So I cannot see any scenario where Tanzania, on access to foreign exchange, and what I know from the Bank of Tanzania in comparison to the Central Bank of Kenya, it's just not, it doesn't square with my empirical reality. And, I'll stop there in the interest of time, but I think in a nutshell, the report is pretty useful for those of us who are either practitioners or are keen on studying African financial markets broadly. I'll leave there. I think I've spoken for too long. I'm sorry, I'm a little wordy. Thanks. Back to you, John. Thanks.
Yeah, thanks, Raphael. Now I would like to invite Kwame.
Yeah,
please go ahead, Kwame.
Okay, fine. Thanks a lot. I have 7 minutes as well, and so I'll make just a couple of comments. One of them is, I think, to rehash what Raphael said about the methodology. This methodology just largely qualitative, and qualitative doesn't mean it's bad. But I think the caution that is required in interpreting methodology when it's based on perhaps views, much as it is for practitioners and people in the market, because if you looked at it, the number of people who've been interviewed are people who actually engage in the market, some regulators, and a couple of others. I think the missing side is basically would be the demand side.
Dave.
The demand side. So I think that's a significant thing to actually bear in mind as we think about what this is. How? Because I think in as much as it's called the African Financial Markets Index, and it's measuring the kind of things that would require, or rather the 6 pillars, try to find what are the things that are necessary to build a financial market that would actually attract more investment. Of course, this is portfolio movement into all that. The idea about the development of financial markets, in my view, should be balanced about the public interest, public trust around financial markets. And that too can be a qualitative thing. It can also be measured. But my thinking is that the utility, so to speak, of the index is focused entirely on what people who actually do the trading and day to day. And the problem with that is that it might focus views based entirely on what it would cost for people who are actually doing the trading or have specific interests and outcomes to disproportionately affect what the findings are by country and overall. So in that, I think there might be scope for the expansion of the methodology to talk about what's the public sentiment end, because obviously depth of the market and whether people decide whether it's through pensions and everything else to push money into the market is dependent on what the demand side, which is basically people who do the savings, think about the competence of the people who run, and just generally that question. So that's one thing about this. One other thing that I think is coming down to the policy questions is the political economy of financial markets development. Of course, more or less tied to my first comment, would be an interesting one actually to do. Partly because some of the choices that I've made, as the previous speakers have mentioned, but more specifically, Rafael mentioning about, say, foreign exchange dealing, the parallel existence of a foreign exchange market in itself is a political economy question. And the feature and the size of the political economy, in my view, suggests, and I think it confirms what the economic freedoms actually correlate with market development. So for instance, if you look at the countries that are up there, and this now, of course, is to affirm that, yes, this financial market index is measuring important things. If you look at the countries that perform well, and I don't think the results that you see largely, you could quibble with a few things in the pillars, but overall it tells you something that's very significant. One of them is, the countries that are there have fairly stable market systems, but that those market systems are themselves the result of those market systems, or those outcomes that are measured are actually the result of, they tend to have a common law tradition, whether you're talking about South Africa, Seychelles, not as much, but basically Mauritius rather, South Africa, and some countries in the south of Africa, of course Kenya as well, in all these other places. So there's something about common law systems and a British-based system and international trading, English being a language that I think is not an accident that we see. So there's a political economy element. One of them obviously is also that the legality and enforceability question is itself underpinned by the fact that if you have systems that are very elaborate, I think there's a citation of Kenya, or Leo mentioned a citation of Kenya and court systems, the ability to resolve questions properly, and that might have something to do with, obviously, systems that are set up, whether they capital markets and stuff like that. So that's legality and enforceability question, and it's telling you that there's a big political economy element to what we are reading as a result. I noticed as well, maybe I shouldn't do this too much, but I noticed as well that in the foreign exchange part, Kenya is last, and that is not surprising. Obviously, because people know, and our view at the Institute of Economic Affairs, but we've been saying this for 2 years, that is Kenya's shilling is due for a market-led depreciation. over the last 3 or 4 years. And of course, it hasn't happened as much, but our view is that that finding is somehow consistent with that view. One other thing that you see is the level of economic formality. I think markets tend to be larger, whether it's depth or just the general size of the markets relative to a country's GDP or nominal size, are consistent with the economic formality. So the more formal the economies in which these markets, the securities markets equity markets are placed, you see higher ranking for countries, telling you something about the ability to actually take savings from whatever part of the economy and to divert them into, to direct them to the capital markets is itself dependent on the level of formality. I say that advisedly, but more importantly about how there's a nexus. So the more formal markets are, obviously savings will definitely be, there'll be options about whether to invest them in capital markets or actually to invest them in other things. So you see again that countries that tend to do well is a formality. So for policy purposes, I think having formal markets, in as much as informal markets are useful, and the formal markets is not used, or informal markets is not used pejoratively, but informal markets actually, the more countries pursue methods and policies that create more formality and expand value through formal markets, I think the better it will be for financial markets index up here. And the final thing that it tells us again is, if you look at, now I'm concentrating on East Africa, if you look at East African countries and you see the very big fluctuations in not just by issue. So for instance, one country does well in this. All the 6 indicators tell us a lot, and I think they're consistent with the capital market growth. Whether they are creators or whether they're results is a different matter altogether, but they are consistent with that. And I think the way you see the performance of individual countries suggests one thing that is still a problem. The coherence of economic policy in East Africa is still one. So you have countries that are establishing capital markets or equity markets, suggesting that governments have broad recognition and that society has broad recognition for the role of markets in general. And then you see walkbacks. So for instance, I think that in Kenya's place, the depth and the size of the market would be generated quite substantially, rather would be built. I think that would be the same for East African countries, more the others. Substantially, if you believe a capital market should exist, then government maintaining huge assets in its control, doing poorly when capital markets would be an opportunity for unlocking value and for their development is one thing. So those inconsistencies still tell you that actually there's a broad case that can be made in terms of policy engagement for the fact that from financial markets depth are important, but given the history of many African countries, and I'm speaking about Kenya as well, I know Tanzania and Uganda as well, if you're continuing to capture these big sectors of the economy in government hands, then you're actually constraining the effects, or rather, you constrain the development and the depth of the markets that you seek. So it's useless to actually seek to develop markets when government holds on to so much of the assets that actually capital markets would give good value to. So those are my thoughts. Thanks a lot.
Yeah, thanks a lot, Kwame, and of course to both to Raphael and Elizabeth for sharing some insights and views, basically as practitioners and also as experts in your own right. Basically, your views around, or your views on the AMFI report, and given that we don't have much time, I will not summarize this, but basically what the three of them have shared is, among other things, some hint of what can be done towards maybe expanding the scope of the methodology to include certain issues that are missing. For instance, in terms of the pool of capital, I think Elizabeth noted maybe there's need to look into the aspects of SACCO funds, whereas I think Raphael noted the aspect of qualitative judgments and the biases that this may bring about. And then, of course, Kwame noted something to do with the need to probably factor demand side and political economy questions that both Raphael and Kwame noted especially with regard to foreign exchange. So with that, I think we'll go straight now into our plenary session. And now I'd like to invite our participants, if you have any question that you'd like to direct to any of our three panelists, including, of course, Leo and Winnie, please do that. You can unmute your mic. You can either raise your hand or just basically unmute your mic, introduce yourself, and channel your question to any of the presenters. So far from the chat box, I think I see maybe 2 or 3 questions. I could start with those as I wait to see whether there is anyone who wants to go first. But from the chat box, let me read this. We have I think there's only one question from Joanne, and our question is, what should Kenya do to transform the pension regime going forward? So this is not addressed to anyone. So let me see. I think Leo alluded to some aspects in relation to the pension fund regime in Kenya. Maybe Leo, you can weigh in on that, and any of the other experts who would like to add something to that.
Yeah.
But so Leo, before you go, let me see so that we have at least a first round of questions, maybe 2 or 3 more questions. Anyone else? Let me see. I don't see any other questions from the chat box. Okay, so Leo, please go ahead, as I guess our participants are warming up to ask questions. So Leo.
So the only way to do pension reform, to reform the pension scheme is for me, for the case of Kenya, I think it's to make it contributory, and for the case of Kenya, the superannuation scheme is a step in the right direction. But what is required, what the level of government control on pension scheme needs to go down to a level of only playing the aspect of regulation, so that you make it contributory and you make it to be based on what you earn. Like what happens in the private sector for the provident fund is what we have in the private sector is you contribute based on your earnings and based on the duration of the employment, because what has been happening in the past is that it's calculated based on the last salary you had, and it's not based on what you contributed throughout your employment, throughout your time in the labor market. So as you can see at present, the pension payments have risen in the last 15 years from around 15 billion to now almost 150 billion. So it has gone up tenfold, and this is a phenomenon that will continue to be seen. But the superannuation scheme that kicked in last year is a step in the right direction to make it part. And the essence of pension is it's contributory, that it's based on what people earn and the duration of employment. And then it's not something. Now the other political economy issues that, let's say, this cadre of public servants need to get this kind of pension, like what the argument MPs are making. So, but generally for the whole labor market, the rules have to be the same, and it has to be contributory. Back to you, John.
Yeah, thanks Leo for that. In case any of our experts, if you like to add something to that, the question is what we need to do as a country to transform our pension regime going forward.
I think maybe just to speak about the pension, the biggest challenge that we have is pension coverage, which is significantly low. I think we have less than I think it's about less than 20% coverage. So one of the largest problems that we have is that most people, especially in the informal sector, are not in any sort of formal retirement benefit scheme. So the question is then, how do you encourage them to be part of that? So, and from where I sit, I think it's largely more on education than anything else, for people to realize that I need to be putting aside this amount of money and just knowing the benefits that are there. Because I think, to be fair to the Retirement Benefits Authority, they have really been trying to come up with regulations that are supportive of growth of that sector. So it is taking action, and the taking action is largely being prohibited by the fact the growth is, in my view, because people do not understand the need of doing this, or whether they should do it anyway, and making it very affordable. So I think there's something that I don't know how the Mbao pension is doing, but maybe those initiatives whereby you're getting the boda person, the mama mboga being able to contribute to it.
Thanks, Elizabeth. Any other addition on that, or we move on to the Kwame, Raphael?
Well, yes, I think, pension systems and the strength of, because pension systems are actually best for capital markets. Well, a part of a strong one for capital markets, especially from the demand side, because those savings are meant for the long term. And of course, using the securities exchange as an opportunity for investment actually helps to spread, helps to put long-term capital into at work. So that's one way. But if you have an informal sector such as ours, where incomes are not regular, and secondly, there's fragmentation. It varies by season, it varies by amount, and we have very, very stringent rules for what qualifies for saving as provident fund and pensions. Then it does. So the big problem with actually countries with a huge unemployment, huge informal employment like Kenya does, and most of East Africa, is that it gets very, very difficult to cost effectively crowd savings, put two savings together so that they can be deployed in the capital, in the securities exchange. So that remains an issue. And that's why I emphasize the part about the coherence of economic policy. If countries continue to pursue economic policies that fragment sectors further, create an incentive for people to continue to operate or to work within informal sectors, but also is not friendly enough to them so that people can actually save, whether it's in small amounts or not, that should be an issue of coherence. Because yes, most of the capital that tend to go, some of the capital, and actually for countries with a good demographic profile such as Kenya, to be a good one to actually match the demographic profile to what does it take for financial markets of size, because I think that also is something that the index should take account of. If you have very mature societies where you have a huge number of people who are working, then the structure of the capital market size relative to the size of the economy would be completely different.
Yeah, John agreed. So I think it's obvious that the informality question is part of the problem to the recruitment of pool savings. So to the extent that we are getting to formalize, increasingly formalize over time, I think it's just a matter of time before you get the kind of pension reform numbers or just capacity question that I think is part of the levers within the report. So I agree with Kwame on that. And Liz's point is also especially very important. I think it's the anthropology of it. The longer we live, the relevance of putting aside savings for our non-productive phases of life will become a reality. So some of it is just an evolution of our own just the country's anthropology, if you will, how we are reacting to the fact that people are living longer than we've seen in previous mortality numbers as a question. In terms of specific pension reform legislation, I think Leo was spot on. So, either contributory or whatever structures there are that would address. I don't think there's any gap. As a matter of fact, the report is pretty specific about capacity, which is just a question of scale. So how much pension resources can you raise vis-a-vis your population? And of course, that is squarely a formality question.
Yeah, thanks a lot. I know we are quickly running out of time. We have an opportunity for, I see only one question in the chat box, but at least for one person, one or two people to ask their questions. As I read out the question from Benda, she makes an observation and I think follows it up with a question. So Benda's observation is that we have seen securities market in East Africa are recovering. So can we say the worst is over as COVID vaccination picks up? I would throw this or pass this question to Liz Nkuku. One final opportunity for anyone before we close. So Liz, you can prepare to respond to that question and make your final remarks. And then, of course, we'll have Raphael, Kemboi, and Kwame can conclude in that order, because I don't see any other query. Okay, Liz, please go ahead.
So in terms of looking at the market performance so far, I think the Kenyan market, the Ugandan market has definitely recovered, but the question is, which is a different, maybe out of context of this, is the structure of the Kenyan market itself, which also replicates maybe what is happening in Uganda. There is a lot of reliance on very few counters. So you have Safaricom over 62% of the market capitalization. You have the banking sector over 20-30%, which have done well this year in terms of profitability. So you cannot take the market performance today to maybe replicate the entire market, because it is not representative. It is not 100% representative from a market cap perspective and from a representation perspective. So I would actually say that, yes, we have seen recovery, but I wouldn't put it that we are completely out of the woods, because if you look at this, I think there is this index that is usually released by Stanbic. There is a lot of oscillation whereby you're just around, just getting out of there, and then in a month's time, then you are back. So there's still a lot that needs to be done. And yes, I believe that with the vaccinations, we definitely see a pickup in activity, but people just need to be a little bit more resilient and really adopt a wait and see, because there are other things that are affecting the economy other than COVID. I think things like the price increases in fuel, that becomes a significant challenge for many people. So I think there's still a lot of structural issues that needs to happen. And if you look, the other thing I would look at is for businesses, maybe even access to credit is not that great, just because of the fact that maybe the government is offering better yields. So even for banks, you are just collecting deposits and passing it on to the government instead of giving to businesses and individuals. So I would really think that the recovery will take a little bit of time, just because of those underlying issues. So in terms of concluding remarks, I think this was great and really informative, listening to people looking at how this is. And I think for this particular index, for me, it's really a significant step in the right direction, because it also brings people's discussion to almost like narrowing down what is really important for the growth of the African continent and markets at large. And from here, my view is that if the various decision makers in government look at this in detail, look at the critics that are coming along, we will definitely see much deeper financial markets going forward. Thank you. Thank you, and back to you.
Thanks, Liz. Raphael, your final remarks?
Well, thanks. Not much to add. I'll just point out, just like the previous speaker, I think Liz, that yes, the report is, and I did say this, is very useful, just in terms of having the data framework going forward. My slight criticism notwithstanding, just to go back on the I think Kwame frames it as a political economy question around management of exchange rate regimes, parallel markets, XYZ. I think for Kenya, if I'll conclude, there is something to learn there, that I think the communication aspects of, because this is one small component of management of monetary policy broadly. So I think the learning for me is that the communication aspects of managing prices, including those of the currency, needs to be very alert to perception. So whereas the intention may sometimes be very well understood and very well meaning, I think depending on how the communication framework is handled, you end up creating this sort of what I think is a distortion in my view in terms of these parameters. Yes, there's no question that the valuation, undervaluation, or valuation of the currency is, I mean, that's quantity. We can prove that using non-economic models. Nobody quibbles with that. I think the issue is how do you manage that recalibration of the currency that is, of course, grounded on the country's external performance within the mandate of just smoothing price levels for whatever intentions you have. And depending on the communication strategy you adopt, I think you may end up being counterproductive. I think that's what's hurting Kenya in that particular parameter, because, and I know this because I've traded foreign exchange daily for the last couple of years. So I really do know what access would mean and how these countries would compare. And then, yeah, just to say, I mean, just to thank the Institute for the work. I think it's likely, for those who hadn't read the report, I think Leo and Winnie did a good job. You probably don't need to read the report. You have sufficient information to comment fairly competently about what the report says. So thank you. Back to you.
Thanks, Raphael. Leo?
Oh, okay.
You can come last.
Yes. So just to emphasize that the performance in the securities market has not improved. It largely is not to re-emphasize what Liz said about the performance in the securities market. For me, unless we see the output gap that COVID brought in being recovered, and also largely the aggregate demand and the country's aggregate supply picking up, we cannot say we are out of COVID yet. In my concluding remarks, I just to say that this has been a very good opportunity to look at the aggregate, the economies, and probably promise that next time we'll be looking more at the continent, have more the continent-wide discussion on what exactly is happening for Africa's financial markets, and to compare it with other indexes and be able to give more insights around it. Thank you so much. Back to you, John.
Thanks, Kamboy. Kwame?
Okay. Well, I think the African Financial Markets Index is launched. I think it's published every November or October. So it's we have just a couple of months rather, to see what the next one is and to record what changes, what the effects of COVID are. We'll be able to tell how robust, because part of assessing the robustness of markets is also how they can deal with the kind of shocks that we've seen. Of course, the wide economy shocks in the real economy, so definitely they'll show in the markets. But the index should allow us to see to what extent that has happened and what needs to be corrected. But on the whole, looking at the 6 pillars, I think the the main argument for us who work in policy is to ask ourselves, what does this mean for any policy engagement that we might make? And I see the one big one, which is it might be useful actually for those who support financial markets and actually about their debt to consider Kenya's privatization policy afresh, partly because I think the fact that government holds a lot of assets that could benefit from, could actually enhance public welfare and the government's financial position as well from using financial markets would be useful, given the overbearing role or the big role that the government of Kenya plays just in the in managing assets and not doing it well. So using the markets as actually part of expanding debt, because the diversity of markets in Kenya is an issue. I don't know what the next one will show, but if you have, say 5 or 6 stocks out of close to 50, representing 80% of the market, then that tells you something about the depth, certainly, because even if you measure the depth, but actually you're just measuring the size of the performance of 5 or 6 stocks, and that's not consistent with good financial markets development. So thanks everyone, and thanks Winnie and Leo for educating us about this, and I'm thankful to all the other co-panelists. Thank you, John.
Yeah, so as we close, thanks a lot to our, we'll start with, of course, with Leo and Winnie for sharing these findings. Actually, as Winnie mentioned, we'll have a bulletin that will provide some more details on this. On the basically, the bulletin will break down and provide some synthesis of the report, of course, with a focus on Kenya and its EAC counterparts. And this is something that we'll continue to track. So the Futures and Foresights program will continue to basically, not only for the financial markets, but also track other important economic trends and as they continue to build their repository of this. So this will be like, we hope going forward, some kind of a one-stop shop for people to be able to engage in terms of just broadening their knowledge and for education, for literacy, etc., as well as using this for evidence-driven public discourse. So with that, I would like to thank our participants for, of course, taking time to join us in this webinar. So thanks a lot, and also to our panelists, Raphael Agung and Elizabeth Nkuku. We are very grateful for that, and just to show that these are actually friends of IEA as well as members of IEA, and this is an opportunity for you, if you are not a member, to join. And you can already see that through this membership, with the IEA, you have an opportunity to engage not only by participating in our activity, but also engaging directly through your expertise. Otherwise, thanks a lot, and have a good afternoon.
Well, thank you, John, and thanks, everyone.
Okay, bye-bye.
Thank you, everyone.
Thank you.